The Federal Reserve cut its benchmark interest rate for the third time this year, citing a cooling job market.
Evan Moon has more on the decision and what it means for borrowers.
Wall Street rang in the trading day with optimism, expecting the third consecutive interest rate cut from the Federal Reserve. And the Fed delivered, knocking rates down another 1/4 percentage point.
We have lowered our policy rate 3/4 percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market.
The benchmark range now sits at 3.5 to 3.75%, its lowest level in more than 3 years.
The Fed basically believes that the job market is slowing down enough that we need a little boost in the economy. We've been in a low hire, low fire environment.
Analysts say it's rare for the labor market to cool while inflation remains high.
Maybe it's due to the uncertainty of the tariffs. Maybe it is due to just generalized anxiety about which jobs are going to be remaining after AI takes hold. We don't know.
With a lack of new economic data due to the recent government shutdown, not all voting members were in agreement. 2 wanted to maintain the previous range, 1 wanted a bigger rate cut, be relatively short-lived. Bank rate analyst Stephen Cates said consumers will see a minimal impact from this cut.
Any single meeting, any single cut is not going to be life-changing for anybody. Nobody's going to wake up tomorrow and feel very different about their life or suddenly have access to credit that they didn't have today.
Cates notes interest on credit card balances and auto loans is still steep.
Fed officials signaled they expect to lower rates just once in 2026. Analysts are predicting a pause on cuts with split views on inflation and Chair Jerome Powell's term ending in May.
President Trump said this week he already has a good idea of who will replace Powell when his term ends in May.